An alternative to have less anxiety is more modern properties. It's that simple. And again, a lot of that links to the tenant profile. Anxiety-based tenants, high turnover, unreliable people, lower socioeconomics. Anxiety-based tenant profile. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, anxiety-adjusted investment. Yes, we all get anxious. What are you anxious about? Let's discuss your anxieties and fears. Today's show, we're going to dig into really anxiety-adjusted investment for returns, what that means, how we can approach investing so we don't drive ourselves cuckoo, why we don't wake up in the middle of the night with cold sweats. Of course, today's show is very much in line with the previous show I just did, which was all about investing in trusts. For a lot of people, that would make them very anxious, but let's have a discussion about the idea of mapping out our investment journey so we don't feel like the world is caving in on us at any given time. I like the sounds of that. But hey, welcome back, regulars. You know the drill. Play the program in double speed, get your life back. And of course, all the episodes I've done are lessons on real estate. So feel free to dart about, grab a lesson or two. Why not? Why not learn something? Hey, I don't know about you, but I am celebrating. Lightning just came and took out the neighbors. Yes, the old gospodar himself was chainsawing stuff in his backyard, and his little mission was foiled because along came a massive storm. And so thankfully I am podcasting without a chainsaw and a leaf blower occurring, and we can thank the gods. The god of thunder came and saved me. But his leaf blower really gives me anxiety. But I tell you what, a lot of people get anxiety from investment. And I guess my last podcast kind of prompted this podcast, because the last show I was sort of talking about to building a massive portfolio, you've got to start with the end game in mind. What kind of economics do you want later in life? Where do you see your life going? And if you start with the end game in mind, how much real estate could you end up with paying you a dividend or a return in your retirement? Obviously, if you want a couple of $100,000 in your retirement, you've got to work out the maths to get there. And along that way, along that journey, there's going to be anxious moments of investment. And really, per my last podcast, which if you haven't listened to, you can go back, but basically, I was talking about to build a portfolio, you might buy some in your own name, you might buy some in your super as a different entity, and you might start a trust as a completely new entity and buy some real estate in that. Obviously, there's a risk tolerance behind all of us, and high sensitivity to risk will create stress. And of course, that makes people uncomfortable. People generally get anxiety when they don't understand something, when they've got to make a decision on spending about money, using real money. And so anxiety plays a part in investment. And the key consideration is to match your investment risk to your personal psychological comfort level. That's really how the two go together. But you've got to be able to also get out of your comfort zone a little bit to move forward. And Tab always says comfort equals dying dreams. And it really is an accurate statement. For a lot of Australians, they just remain very, very comfortable. A lot of people with good jobs, earning good income, uninvested, haven't got out of their comfort zone, haven't made the effort to get out of their comfort zone. And anxiety will come in forms. Effort anxiety, the actual effort to do something is a form of work, and that can make people anxious. Not knowing what you're doing and borrowing large amounts of money makes people anxious, and I can completely understand. But if we can get some predictability in how we invest, we of course don't need to be as anxious. So some anxiety adjusted investment principles, which I like to teach, which I like to share. And of course, the first one is the predictability around investment locations. Obviously, you're going to be less anxious if you invest in Sydney as opposed to Dubbo. You're going to be less anxious if you own real estate in Brisbane compared to WeWar. So predictability is really one of the best ways for you to avoid anxiety. And I've seen this a lot with investment. People run off to small little hotspots in the middle of nowhere. They might be in the news when you buy, but then they soon leave the news, and then you simply don't hear about those marketplaces. And that lack of noise, that lack of information, that lack of seeing what's going on can create so much anxiety for people. And it's fair to say that we're sort of creatures of comfort when it comes to anxiety. So if you're watching the news and you see Melbourne, or you see Brisbane and see Perth, and you see it regularly, you feel pretty comfortable in the predictability of those places. It's just more of a recency bias of comfort. And of course, from an economics point of view, obviously big markets tend to be quite safe marketplaces. So less anxiety in predictable places. And of course, if we can also look at predictable returns, it makes us less anxiety. And what I mean by that is we know suburbs 30 kilometers from the city center of any CBD predictably have gone up in value over the last 40 years. It's a very predictable evidence-based logic. We know that people like renting certain styles of properties. There's a predictable nature of what people like to rent. There are predictable suburbs of where tenants love living at certain stages of their life. And so again, that evidence-based predictability is just a great way to avoid anxiety. We know lifestyle suburbs are very predictable in their behavior, that the right lifestyle suburb in an urban area is where people are going to want to live. So you're going to be less anxious buying real estate in those marketplaces, and you'll get a predictable level of growth and a predictable level of rental return. So we've just got to think about how we invest, because as we grow older, we change as human beings. What seems like a good idea at the point of buying can be an absolute nightmare thereafter. So we also need asset risk tolerance when we examine and enter the real estate marketplace. A speculative asset, a speculative project, a speculative renovation quite often looks fun, but can end up in a situation where it just creates so much anxiety for a human being that they, once finished the project, get right out of the industry being investment building. And it's a shame, because if you just stick to the basics, establish residential properties, you don't have to have this high asset risk portfolio of developments and commercial property and industrial property and Airbnbs and all these type of things, if that's going to meddle with your anxiety levels. You can do it the slow and steady way. Many people have. And again, if you think about your risk tolerance, this is about you understanding your risk tolerance. Are you going to have the risk tolerance to own a commercial property whereby the vacancy could be a year if market parameters change? Are you going to be able to deal with that both financially but also emotionally? You don't want real estate to age you. You don't want investment to age you. You want it to be fun. You want it to be less full of anxious moments and more full of upside and benefit. And of course, when it comes to making sure you invest for anxiety adjustment, then liquidity is a big conversation piece. We want liquid assets, not illiquid assets. And quite often, I see this a lot. People will invest in an illiquid market, in a liquid property type, and get stuck with the real estate for a very, very long period of time and be unable to sell it. Because when they bought it, it was a fad, but because where they bought and what they bought, and in particular, some of these sort of more speculative marketplaces, you see a level of illiquidness come into the investment and then someone can't sell. And of course, the toll that takes on someone's anxiety levels and physical health can be very, very distressful for people. So keep it simple. This is all about keeping it simple. Keep it simple. Good established areas, good cities, simple formula, liquidity. You'll be able to sell the property if something comes up. And you never know when a problem's going to arise in your life, or you've got to pivot to take care of something else that was unexpected. And that's fine, because in real estate investment, we want a moat, an economic moat around us. Really, if you think about the idea of you've got your job and you've got your superannuation. It's kind of the last, stronghold. But if you go further out, you've got to build a moat. So then you've got investments, you've got investment properties, you've got a diverse portfolio, you've got properties in different cities. You've got diversification and a moat, and if you need to chop a limb off, you can do it, and you won't put yourself in a position where it's a big anxious move for yourself. It'll just feel right. It'll just feel right. Obviously, debt exposure is one of the easiest ways for someone to get anxious. When you've got a situation where you've bought a property and you've leveraged up, for a lot of people, if they're sensitive around that, then all of a sudden they can become very, very anxious. And again, you might borrow money at 4%, which becomes 6%, and all of a sudden your debt exposure and your money you're spending on a property starts to really makes you very anxious. Oh, what have I done? Now I can't, I have less disposable income. I'm pouring money into this property. And again, your anxiety levels can get very, very, very high on that. And of course, some of the best high growth real estate actually is the lowest yielding real estate in the marketplace. So when your debt exposure on high growth property is not paid by the rent, then you're paying a lot of money out of your back pocket to prop up the real estate, hoping eventually the real estate will grow. It's like a burn rate versus a growth rate. And again, for a lot of investors, that's perfectly fine. But for other people, all of a sudden anxiety kicks in that they're trapped in basically a debt exposure cycle and they sell out. They get out of the investment. And again, it's knowing what you want, because maybe you have to sacrifice a little bit of capital growth, the type of investment you go off and buy, or when you're speaking to your advisor, you recognize that you want a better yield to compensate for the anxiety of holding real estate. The better yield will probably come at a cost of higher levels of capital growth. But if that's how you want to invest, that's really a decision you need to really be open about and talk about. Because most investors really who don't deal with the anxiety adjustment need to surrender something to feel good will quite often go for the highest possible capital growth. When I broker real estate, I'm fairly well conscious that the burn rate of real estate, the after-tax cash flow of real estate, can quite often put people in a position where they're very anxious to the point where they're really uncomfortable holding the real estate. So I tend to also find real estate for most people that actually is a blended investment. It has good capital growth perspective, not the highest, but also good yield growth perspective, which allows for the investment to be held a lot longer. The idea of the holding costs of the real estate tend to be taken into consideration, and there's a real break-even point goal with the investment so that the anxiety of holding the real estate doesn't feel like you're going to have to be negative cash flow for 20 years just to get capital growth. Obviously, there's a negative geared property, a neutrally geared property, and a positively geared property. And if you can get the right formula, you can end up with basically a neutrally geared property around 5-6 years after ownership, which is really a good scenario for people, because what people do is they'll get interest-only loans for the first 5 years of owning a property. Then it switches to principal and interest. And of course, the payments are a lot higher. And that all of a sudden, that debt exposure versus cost of borrowings creates a lot of anxiety for people. So again, like just some ways to think through who you are and what you want. And of course, how you can apply your comfort zone to the real estate marketplace. But again, I think all of us need to get a little bit outside of our comfort zone or we don't grow. And if you're not growing, you're going backwards, right? So we've always got to be growing who we are, what we know, and how we do things. And really the best way to feel safe around investment is to make sure you hang out with other investors. Make sure you get yourself a group which you can rely on to get investment coaching or information. And that is really why we find that a lot of people who try and invest by themselves don't get very far, because they become very anxious and talk themselves out of investment. So to make sure you adjust for anxiety, I would also recommend that you consider the idea of low maintenance properties. Properties which do not require huge capital cost expenditure, that don't require huge spends on low dividend items, things like new roofs, new fences, new plumbing, new wiring. All of that is just going to really put a lot of people in a position where they're completely uncomfortable. And you'll get very anxious when you are constantly getting your rent eroded by toilets and taps. And I say this all the time. It costs the same amount to fix a toilet in a $500,000 property than it does a $5 million property. And the problem with the wrong property, the wrong really aged property at the end of its life cycle journey is you're going to get a lot of repair bills and your rent may not even cover it. So all of a sudden you're going to get a lot of anxiety and you will sell the investment. You'll get out of the investment, and that's all going to rob opportunity. Opportunity costs. Opportunity could be invested in something else. It's going to cost you sales fees. It's going to cost you taxes. You name it. You're going to be paying everyone. So an alternative to have less anxiety is more modern properties. It's that simple. And again, a lot of that links to the tenant profile. Anxiety-based tenants, high turnover, unreliable people, lower socioeconomics. Anxiety-based tenant profile. Reliable tenant profile that causes no anxiety, long-term, high income, high quality tenants. You see the difference? It's a big difference. Obviously, there's other things that cause anxiety. Economic sensitivity will cause anxiety. If you think about speculative growth areas versus like areas which will perform in a downturn and just hold value and maybe drop in value a little bit, you will feel more comfortable. And I've got the lashes on the back from this, from downturns. When they come, they're not nice, but they're less anxious in Sydney, and they're less anxious in Melbourne, and they're less anxious in Brisbane and Adelaide, where the population is, compared to a downturn in a small regional place. That in itself creates a lot of what next? What next for this place? What happens when a one industry town shuts its industry? It decimates a community. The anxiety that creates by doing that investment is going to bite people so hard that it will definitely derail people's economics. So again, we can go through some factors that we need to adjust our anxiety for. And if we start with, for example, insurance. Insurance is a big thing. We want insurance on our real estate. If you go to a climate problem area, you're going to have problems with insurance. If you go to a high crime area, you're going to have problems with insurance. If you go to a low socioeconomic high crime neighborhood, you're going to have problems with insurance. If you go to a fire prone neighborhood, you're going to have problems with insurance. That's going to create anxiety, as opposed to just researching and not going to those areas. If you invest without a buffer, a cash flow buffer, you're going to get anxiety. Now, when you've got $500 in the bank, how do you feel? We've all been there. You feel pretty scared. You feel pretty anxious. When you've got $100,000 in the bank, you don't feel scared. You don't feel anxious. So you've got to work out what your amount is that makes you sleep at night. And again, sometimes you have to use emergency buffers, but they're buffers to financially protect you. That's the point of the buffer. And when you use it, you've got to pivot and work out how to restore your psychological level of money in the bank, your liquidity level. Cash buffers are an important principle of investing. I'm dealing with a friend of mine who doesn't take advice from me, but comes to me for advice when doesn't take advanced advice from me, but comes to me for advice when things go wrong. And you don't want to be that person. You want to plan and set the sail. You don't want to spend your life like, holy cow, how did I get to this position? That's a very horrible place to be. She is so anxious right now. She has a $3 million property and $1,000 in the bank. No buffer. And again, like if she set the sail right and she had the team working on her situation, she would not be in that situation. She did not invest based on the adjustment for drama. And real estate is full of drama and it makes you anxious. And of course, some properties out there that you can go off and buy have regulatory impositions on them. That's going to make you anxious. If you've got hazardous materials in your property, if you've got properties which are unsafe, all of that is going to trip you up, and you will get picked up through regulatory risk. And again, all of that will make you anxious. The opposite of that, just don't invest in those type of properties. Don't buy the hazardous material house. Don't buy the property with cladding issues. Don't buy the property with challenges. Just avoid it. Real estate investment is really about what not to buy as much about what to buy, and where not to buy as to where to buy. And so all of these things add up to really the idea that we want the right risk tolerance for us. We want the right predictability and evidence based around where we invest and the type of tenants we invest to have in our assets. We want the right asset tolerance. We don't want a risky asset. We want the right market dynamics so that we're not speculating in whoop whoop. We want our real estate always liquid, not illiquid. We want to manage our debt exposure by making sure we don't bite off more than we can chew, and our cash flow profile is strong. We want to make sure our after-tax cash flow allows us to control debt so we don't have big swings of anxiety. We don't want economic sensitivities of changes in the market to dramatically change our long-term goal, which is to retire with real estate and get income from it. So imagine owning a property with a retirement plan that you were going to use that property's growth and rent, but it's in a single or multiple industry town whereby something goes wrong in that area. Investing in economic sensitivity is about going, well, what city makes me less anxious? Sydney doesn't make me anxious. There's that many taxpayers here that even if Sydney had a bad day, they'd work out how to fix it. It's just the way it works. We want to make sure that we invest where our assets' health is going to correlate to our investment time horizon. We don't want big issues with our property on the journey. Massive maintenance problems, big capital cost problems. We don't want our property be a regulatory risk, an insurance risk. And you personally always need to have a cash flow buffer so that you can navigate through the ups and downs and changes of the economy. And of course, Everyone needs an exit strategy. And of course, when you don't know your exit strategy or your overall plan, investment can be really weird. It can feel strange. And for a lot of people, they don't know where they belong, even though they have an asset and what they're doing with the asset, which is obviously going to create anxiety and complications and probably lead to a failure from investment. If you have a clear exit, how long am I investing for? What am I putting into the market? What am I trying to get out of the market? And what is my end game? You're going to have a much better ride when it comes to property investment. All right, guys, don't be anxious. But I can tell you, the best way to avoid anxiety with real estate is to avoid anxiety with real estate. On that piece of wisdom, I'll catch you later. Thanks for tuning in to the Urban Property Investor. To never miss an episode, make sure you subscribe to the podcast on your favorite app or on YouTube. I would love it if you could give the show a rating and share it with your friends and family. In between episodes, you can always keep in touch with me by connecting on social media over Facebook, Instagram, or LinkedIn. Until we meet again on the next episode of the Urban Property Investor, take care and bye for now.